All right, I think we can probably get started now. So hello, everyone. Welcome to this second week. And the agenda for today is to go through a range of integrated practice problems, as well as to go through the content for units 5 to 7. And so what we're going to begin with is pick up on some integrated problems that we covered last week, which was about units 1 to 4. So when you think about these problems for CA, I want you to think about approaching a very big problem or a very complex problem and to break it down into a number of steps. So this is going to be the way in which we're going to teach. And of course, what you also need to do is that you need to look at some of these problems yourselves. Okay, so not only listen to what I have to say, but to actually do it in person, because that's going to be quite effective for you. And that's really going to build familiarity as well. So for the problems, we're going to do 2 of these in the first half of the lesson, which is number 1, looking at how to prepare a cash flow statement, and then number 4, looking at an example for calculating current and deferred tax. So let us begin each of these. So this one here, which is a cash flow problem, has been adapted from one of the activities. And again, the level of difficulty in this should be fairly similar to what you would expect in the final exam. And so if we have a look at what is the required, okay, so every time when you look at the problem, you should always read what is the required or what is the task. Okay, so the task here is to prepare the statement of cash flows for Flexi Pty using the direct method. Okay, and so the context is that you are the chartered accountant working for Flexi Pty Ltd, and you have been provided with an extract of their information. Okay, and in addition, we have some further information for the year, for the financial year, which is that all revenue is made on credit. The other expenses section, which is here, includes 10,000 in interest paid. There were no disposals of equipment during the year. Equipment was purchased for cash. Flexi undertook a share issuance. Okay, so and then undertook a share issuance. An interim dividend of 50,000 was paid, and there are no temporary differences for tax purposes, which means that the accounting treatment and the tax treatment is all of the same. Okay, so how should we go about doing this problem? So, like I said earlier, the initial problem looks quite intimidating, but it doesn't have to be like this. In fact, what we're going to do is we're going to break it up into different segments. So the first step is to think about, well, this is ultimately a cash flow statement problem. And so it probably makes sense to think about, well, which accounts impact which part of the cash flow statement. And so it's really about categorizing each of the transactions and to put it into their respective component within the cash flow statement. So obviously for cash, that is obviously going to be cash. Trade receivables, allowance for impairment losses, they're going to largely be operating cash flows. Anything with equipment, anything depreciation would be within investing. A bank overdraft, again, is cash. Trade payables is operating cash flow. Dividend payable, current tax liability, again, those components will be one, financing cash flow. The tax liability will be an operating cash flow. Share capital, okay, so the company has issued shares during the year, okay, so we were told that in the additional information. That is going to be a financing cash flow. Revenue, impairment losses, bad debts, other expenses, income tax expense, and even the dividends declared, they're all going to be operating cash flow. Okay, so the first step in solving this problem is to categorize the different balance sheet and P&L items into their respective segments in the cash flow statement, right? So again, recall back in Unit 2, we had three different major segments within the cash flow statement. So there's operating cash flows, there's financing cash flows, and there's investing cash flows. Okay, so that is going to be the first step. The second step, which builds on from the first step. Okay, so often in a lot of these problems, you'll find that each of these steps are going to depend on each other step. Okay, so you need to get step 1 right, and then that's going to be helpful when you do step 2. And then from step 2, you go into step 3, etc., etc. So one of the questions that I get asked is, well, what happens if you stuff up step 1 and you carry that forward to step 2 and step 3, step 4, etc.? Well, the answer is that when you make a mistake, you only get penalized once for it. Okay, so there isn't this idea that you're going to get double marked, and so potentially, as long as you get something wrong, you will get penalized on that. Okay, however, that's not going to flow through, and so you only get this negative penalty only once, okay, which is quite generous if you think about it. So that's how the CAA will treat these sort of mistakes, okay, is that there is no double penalty, it's just single penalty. So in terms of our next step, we need to work out how to reconcile the cash that has been paid or the cash that has been received for each of these major components. So because the question is asking us to use the direct method of cash flow statement preparation, what we're going to do is we need to set up some T accounts in order to derive what those amounts are. And so the T accounts in this question relates to cash receipts. Okay, so what is the cash that we have received? So you can see that this is clearly going to be looking at the trade receivables T account. Okay, so any revenue that is earned by the company is booked as a debit in trade receivables. Okay, so that's why the sales revenue sits on the debit side. For the items that then result in a decrease in trade receivables, okay, we have the allowance for impairment losses, we have bad debts expense. Okay, and so they sit on this credit side. And then for the allowance for impairment loss, we need to think, well, what impacts this account here? So we know that the impairment loss T account is going to be related by what is the impairment loss expense. Okay, so any increase in impairment losses gets captured as a credit here. And then any amount that is actually written off is going to be captured in this debit side. Okay, and this is the trade receivables. So we work through this logic across all of the accounts that we identified in step 1. So looking at the T account for cash payments, again, we've got the trade payables. Okay, so any expenses, other expenses that we would have occurred that would go into the credit section. Any amount that we actually did end up paying would be a debit to trade payables. And then the so on for the current tax liability. Okay, so what's the opening balance? What's the closing balance? What's the income tax that's actually being paid. So this is the cash, and income tax expense is the expense, okay, or the accrual. Equipment at cost. So again, so what's the opening? What's the closing balance? What was the cash payment for equipment? For dividends payable, what was the actual dividend paid? Okay, and then for share capital, what was the amount that was issued by the company? So working through all of this, it's simply going to be a matter of taking the information from the question and then to plug in the different parts. Okay? And so if we have a look here, we can see that for the cash receipts T account, we've got an opening balance, we have a closing balance. Okay, so that's information given to you in the question. We're told that sales revenue is 5.5 million. Allowance for impairment losses was 80,000. Okay, we are also told that bad debts expense is 10,000. And so it's a matter of balancing each of the sides. Okay, so therefore the missing number or the plug, okay, is 5,660,000. Okay, now this 80,000, which is from the impairment loss allowance for impairment losses, where did this come from? So this 80,000, you can see it traces down to this number here. Okay, so we have an opening balance for impairment losses. We are told that impairment loss expense was 70,000. Okay, so if you think about, so we begin the year with an opening balance of 60,000. We're told that impairment loss expense is 70,000, and we're told that the closing balance is 50,000. So clearly, there's going to be a plug, okay, or a missing component in order to reconcile or balance this ledger or T account. And so this missing component is going to be this trade receivables, which is 80,000. So it's going to be 60,000 plus 70,000 minus 80,000 is going to give you a closing balance of 50,000. Okay, and so this is the type of arithmetic that you would need to demonstrate when you go through this particular exercise. And so you can see that it's really, again, a matter of putting in the missing values for these T accounts and then draw up a lot of T accounts. Okay, so really what you're doing in one of these T accounts, you're replicating that across all of the other T accounts. Okay, so you're using the same principles, right? So for current tax liability, we can see that again, our opening balance is 300,000, income tax expense is 426,000. We're told that the closing balance is 426,000. So therefore, what's going to be the missing plug is going to be this income tax paid, which is 300,000. So you can see that the question itself seems intimidating or it's difficult because there are multiple T accounts, right? And then you can see that the same logic will apply for equipment, for dividends payable, for share capital, so on and so forth. Now, one of the areas that you do need to be careful about is with respect to this other expenses component, okay? So this other expenses component here, in the question, it's saying that this includes interest and this also includes depreciation, okay? But because we are interested in understanding what is going to be the cash that is ultimately going to be paid, we need to net out these two effects, okay? Because depreciation is a non-cash expense, okay? And so you can see that this is where the other expenses, just minimize that, so it's not allowing me, got this, yeah, I think you can see the note on the bottom here. I can't see it, but hopefully you guys can see this note at the bottom. But that just tells you the logic behind why we need to net out these two components, okay? Because they largely don't relate to the cash, okay? And so when we do all of that for each of the accounts, we are pretty much at a position where we can take all of those pieces of information and put them together, right? So by doing all of these T accounts, we have implicitly derived each of the major categories of cash inflows and outflows across operating, investing, and financing activities. So again, you can see that the income tax paid, this 300,000, okay, this 300,000 is effectively related to this number here, okay, 300,000. The cash receipts from customers, okay, so this 5,660,000. Where did that come from? It came from our arithmetic exercise that helped us balance out this T account. Okay, so this 5,660,000. Okay, that's where it came from. And so you take all of these balancing items from the T accounts and you put them into their respective categories. Okay, so this is again, the step 3 builds on step 2. Okay, and then step 2 builds on step 1. Okay, and so this final exercise should really just be a summary of the information that you have so far computed. And so the statement of cash flows for Flexi Pty Ltd is broken down into 3 components. Okay, so the cash flows from operating activities, the cash flows from investing activities, and then finally the cash flows from financing activities. Now, with a cash flow problem, what is going to be quite nice is that we know if we're ultimately on the right track or not, because we can see that the cash flow statement is ultimately going to give us the net amount of any cash increase or decrease. And so this net increase in cash held, okay, which is the result when you sum the operating, the investing, and the financing activities together, okay, this number here has to be the difference between the opening and the closing balance for the cash account in the balance sheet, okay? So you can sort of check your work as you go through this exercise to see if you've made any errors. Now, if you find that this net increase in cash held is not equal to the change between opening and closing balances, then clearly there is an error somewhere. So where could the error be? It could be, the error could be in cash flows from operating activities, the error could be from investing activities, or could be from financing activities. So again, you can then go back to step 2 and then think about where you may have made the error. Okay, so that's going to be how we're going to resolve this problem of putting together a cash flow statement using the direct method. So step 1, you find the different components, you categorize them, okay, into their respective areas. Step 2, you set up your T accounts, okay, you apply some arithmetic to find out your missing values. And then step 3, you take these missing values and you write it up in the actual statement, okay? And at the same time, you'll be able to look at a reconciliation as well. So with that, I will leave it here for any questions. So is that all crystal clear? Yeah, so there has been a question, which is that, well, how do we know where the different information is? Okay, so I guess what I would say to this is that with the CA, the information is going to be provided to you. Okay, so you'll never be in a position where you haven't been given enough information. In fact, you could be given more information as opposed to getting less information. So if we walk through maybe one of these examples, which is looking at maybe equipment at cost. Okay, so step 2 of our process to go through the cash flow statement is that we need to categorize different components of the transaction. And if we look at equipment as an example, during the year, we were told in the initial question that there was a purchase. Okay, so equipment was purchased for cash during the year. So how can we work out the amount that has been purchased? Okay, is that we need to look at where is equipment going to be stored on the balance sheet. Okay, so the equipment is found at this item here, which is equipment at cost. Okay, this account is also known as PPE. Okay, or known as property, plant, and equipment. So you can see that the 30 June X6 is going to be the current year, and 30 June X5 is going to be the prior year. So between the current year and the prior year, there has been an increase in 500,000. Okay. Now this increase clearly demonstrates the additional equipment that has been purchased. Okay. And so that is how, in this exercise, we need to link all of the information together. Okay. So again, if we take another example, which is, if we look at another T account, which is this dividend payable. Okay, so the dividend payable is has an opening balance. It's got a closing balance. Okay, so how do we find the opening and the closing balances? We need to go back to our information, which is here. Okay, and we are told that dividend payable had a closing balance of 120,000. So it had an opening balance of 120,000 and a closing balance of 150,000. We're also told that an interim dividend of 50,000 was paid. Okay, and so we again get all of these pieces of information, we put it together, and that's going to be how we construct our T accounts. Okay. If we look at, say, another one, so, okay, so this share capital account. So this share capital account is going to be in equity. Okay. And so the share capital account has an opening balance along with a closing balance. Okay, so this opening balance, 1.2 million, this closing balance, 2.5 million. Where is that from? Again, that is going to be from the information. So we go back, have a look at share capital. Where does share capital belong? Share capital belongs, oh, I don't know what I've done. Share capital belongs in this part here. Okay, so again, it's got this opening balance of 1.2 million. It's got a closing balance of 2.5. Okay, so clearly the share capital account has gone up, which means that we have, issued new shares during the year. Okay, and that is going to be how we solve this one. Next, if we have a look at the trade payables, okay, so this trade payables, we are told that the opening balance is 680,000, the closing balance is 590,000, okay? So these two amounts, again, will come from the question, okay? The other expenses, okay, which is this amount here, okay, where do we find other expenses? Okay, we find other expenses from the P&L section, okay, so the other expenses is from the P&L. Okay, so this other expenses we're told is 4 million here. Now it goes other expenses includes depreciation and interest expense. Okay, we know that for our purposes that we do not want depreciation and we do not want interest expense. Okay, because these are going to be separate components. So what we must do is we must separate them out. Now we're told in the other information, this additional information here, that interest expense is 10,000. But what about depreciation expense? Where do we find depreciation expense from? So depreciation expense must come from this component here, which is this accumulated depreciation of equipment. And so the change between these two amounts between each of the years shows what's going to be depreciation. So if we take the difference between that, which is 450,000, okay, that is going to be depreciation expense. And so when we go back and have a look at our trade payables T account, you can see that for this other expense, we need to reduce both the interest component and the depreciation component. So 4 million, which is the total amount, minus 10,000 minus 450,000 is going to give us 3,540,000. And this again becomes a simple arithmetic exercise where we can work out this missing item, which is our cash payments to suppliers, employees, and others. Okay. So there's another question here, which is, do we need to show all the workings, including the T account? Well, in this case, for computing the cash flow statement using the direct method, showing your workings is going to be very important. Okay, you don't need to necessarily lay out the format exactly like this. Okay, you can use a more simplified format where you can sort of use some abbreviations for closing balance or opening balance. But it would be highly advisable for you to show your workings, because as I said earlier, if you do happen to make a mistake from step 2 and then it carries forward to step, if you make a mistake from step 1 or step 2 and it carries forward to the remaining steps, then the examiner or the marker is going to be in a position to see how you have used your, they will be able to see how you've actually used your logic to go through these things. And so that is going to be why workings are going to be important. So if you have nice workings, then chances are you're going to get some marks for that. Okay? If you just carry forward a mistake and you have no workings, then obviously we don't know what you're thinking. Okay, and so that's why, you know, in an exam format, using workings is going to be important. Okay, showing workings is going to be important. It's going to be part of the a key part of how you pick up some of these partial marks. Okay, so I would highly recommend you include workings. So the another question here is, what is the logic to place the opening balance or closing balance into whether it is a debit or a credit? So this comes down to a basic accounting identity, which is the number of accounts in the balance sheet or in the P&L. Everything is a debit or a credit, okay? But for certain accounts, such as assets and expenses, okay, you know that a debit means that the expense or the asset has gone up, and a credit means that it's gone down. Now, for liabilities and equity, it's the reverse, right? So a credit means that it has gone up, whereas a debit means it has gone down, okay? So we need to use that logic, okay, or that rule or principle in order to back out these T accounts. Because if you don't have that level of knowledge, then what I would say is I would highly recommend you just review some basic journal entry questions, okay, because that's going to be quite important for you. Now, you have to remember that the CA assumes that you're not going to be you know, that you are of a level of proficiency, right? So again, if we think about our example here, like this equipment at cost, this is ultimately an asset. Okay, so we know that most asset accounts, they will generally be denoted as on the debit side, okay, because assets are usually positive numbers, and positive numbers means that that they exist, right? And so it's going to be the opening balance is going to be a debit at equipment at cost, and so that's why this opening balance is going to be on this debit side as opposed to being on this credit side, okay? And so we know that the additional increase in equipment over the year, so the company has acquired equipment, so this is going to be debit and asset, okay? So debit and asset, and then there's going to be a credit to cash, right? And so this debit to asset is what is recorded here, okay? Now this closing balance, the style that the institute prefers when it puts these T accounts together is to always put this closing balance on the other side, okay? But really, at the end of the day, it's going to be this number down here, this 2.5 million, that reconciles to this 2.5 million, okay? And so remember, when you're doing the T accounts, it's always about reconciliation. The debits have to equal the credits, right? I mean, this closing balance, you could have said, you know, you could have put it down here, 2.5 million. But the core process is that you need to be able to reconcile. Okay, so all debits must be allocated to credits and vice versa. And then if we need to find the plug, okay, so again, we have like these plug numbers. Where did they come from? They simply came from the differences that existed between an opening balance journal entry versus the closing balance. Okay, and so again, I would highly recommend you have a look at some of these underlying accounting principles. Okay, if they're not as familiar to you, and then in your spare time, go through this question, because it's a great question that demonstrates a lot of key skills. And in the case that this happens to be in a final exam and you've practiced it, then it's going to be very easy marks. So with that, if there are no further questions, let's leave it here. We'll start up another session where we can go where we will go through the next example. So I'll stop sharing and I will see you very shortly. Bye-bye.